All right, so let's move on. So let's start with the B again. Senior Nathaniel, if you are around, you are making your suggestion before my network went off.
Yes, sir.
Sorry for that. You disturb. You have to go back again. My network dropped. I don't know if.
Okay.
All right. So
All right. Okay. Yeah. So I was saying that um the two issues. The first one is that there there has been a series of overclaiming of donations, and when we look at the tax law, the donation should be a worthy cause, and there should be evidence to show. This is allowed once in determining the chargeable income.
okay.
So Kofi, excellent professional consult, they should exercise professional behavior if they want to accept this engagement or this tax assignment. They should
Okay.
exercise professional behavior, paying due regard to the tax laws, not to the consequences ahead. The B issue is that also some of the revenues are not recorded in the books of the business. Uh, for proper assessment of tax, the revenue and expenditure should be accounted for in order to determine the tax liability. But in this case, the revenues are being understated. It says that some of the revenues are not recorded, so they are understated. Kofi should exercise objectivity and integrity since Fungo Limited has special packages for them. So they should be ready to uh, not not to be biased. They should be straightforward and they should be honest.
Okay. All right. Thank you very much. Thank you very much. You have said all you said all the things, so I don't know what me I'll say again. Mm. That's the first one. Donations are claimable according to section 100 of the Income Tax Act of Act 896. Donations should always be for a worthwhile cause, which are claimable once before you pay tax. They have overclaimed donations intentionally to reduce their tax liability, which is an ethical behavior. So excellent professional counsel should make sure that they've exercised professional judgment. They are objective. Because if you see, the managing director is saying that they have a special package for them. So this will not impede upon their objectivity. Show that even the management of Pugu Limited, their integrity is at stake. Their integrity is at stake because they are not doing the things in accordance with the tax principles. For the B part, they are not keeping proper records. It means that their record keeping is improper. Some of the revenues were not recorded in the books. And you know that if you are not keeping proper books of account, Section 73 of the Revenue Administration Act 915, there are penalties for not keeping proper books of account. There are penalties for not keeping proper books of account. So for them not to record some of the revenue, in order to understate the revenue so that they will pay less amount of tax, it is an ethical behavior of management. So Kofi should make sure that the revenue, the objective, they are not biased. The Google Limited should declare the correct amount of revenue so that they'll be able to pay tax on it. That's all. It's not all the ethical questions that you have to talk about: integrity, objectivity, professionalism. Blend all of the two of them. Whatever you think is unethical, write it. You are good to go. Question three. Question three there is simple. It's for you to look at. Manufacturing companies. They have the company have 8 subsidiaries. So all of them they're in different locations, and all of them they are to different activities. So you have to determine that. So let's read the question three. Tanyamichi, can you read the question three for us? This is Tanyamichi here. Okay, if she's not here, let somebody read the question three for us. Or if possible, we leave the question three crowd. Mr. Gamichi, are you here? So Dawadawa Group of Companies has 8 subsidiaries, companies located in Ghana. These companies include the following. We have Kakao Daddy Limited, a soap manufacturing company, which is located in Accra. Kani Limited, located in Kumasi, manufacturing stationaries. Dan Limited, engaged in furniture manufacturing, located in Winnipeg. Kukuwa Limited, an oil plantation business, located in Wa. In Charge Limited, located in Cape Coast, involved in cocoa farming. Jose Limited, dealing with equipment manufacturing and situated in Tema. Kaklo Limited, involved in waste processing. PKL, a private university that reinvest 100% of its profit after tax back into the business. This business is located in Ho. Okay, with its diverse portfolios, the group is positioned to leverage opportunities in both industrial and agricultural sectors. Each subsidiary faces a different tax landscape based on the industry and geographical location, which can significantly impact their tax liabilities. So we know that each of the companies are located in different areas and then to different activities. So based on their locations and type of activity and type of industry, they will have different tax liabilities. They will have different tax implications. These businesses commenced operation on January 1, 2022. So the financial results for the businesses for the year ended 31 December are as follows. So their net profits before tax for 8 companies are here. Also, management of the company is planning to invest in poultry farming, but is contemplating the best area to locate this business. They want to equally engage in poultry farm, but they are contemplating on the best area to establish the poultry farm. Okay. The management want to locate the poultry farm in Winnipeg as opposed to Wa, which was proposed by the chief accountant of the group. So the requirement, you have to compute the tax payable by each of the business and the Dawadawa group of companies for 2022 year of assessment. So each of the groups, each of the subsidiary, we have their net profit before tax. So this question, what you have to do is the locational tax incentives and the type of industry with its applicable tax rate. So let's take them one by one. Let's answer the first question. So for...
please maximize your distance small. The font is too small for us.
You can see. Hey, this one
yes, please maximize your.
I've increased it power. Is it the same for everybody? Is it the same for everybody?
So please.
No, it's okay.
Yeah, I think it's okay.
This one I've increased it. Sister Nyamichi, then you have to get 2 eyeglasses. So let's look at each of them and the location. Now, the first one, which is, what the name is that? Kakao Daddy Limited. It's a soap manufacturing located in Accra. So what will be the tax rate?
25%.
25%. So the profit, this one, the tax will be what? Multiplied by 25%. The next subsidiary, Gani Limited, is located in Kumasi, also into manufacturing. What will be the tax rate?
18.75.
18.75.
18.75. So this will be multiplied by 18.75%. Then you are getting your tax payable, straightforward. Then the next one, Dan Limited, engaged in furniture manufacturing, located in Winnipeg. What will be the tax rate?
12.5%.
12.5.
12.5%. Then followed by Kukua, an oil plantation business in Wa. What will be the tax rate?
5%.
5%. So just multiply by 5%. Very simple. If you know the rate there, you'll be smiling. 5%. Then in charge limited, located in Cape Coast, primarily involved in cocoa farming. What will be the rate?
18.5.
No,
This one there.
I think it's good.
It's
Yeah.
farming. Sorry.
Farming.
So what the rate?
Senior, cocoa farming is exempt.
Thank you very much.
Exempt.
You said so. I wanted to slap you over there before.
I did see. Sorry.
Income from cocoa farming is exempt from tax. No, they don't pay. The Jose Limited dealing with equipment manufacturing, situated in Tema. What will be the rate?
25.
25%. Then Kaklo, where are they? Where are they located? The Kaklo Limited involved in waste processing. So waste processing companies, what's the tax rate?
So they'll pay 5% for the first 7 years. And then after that, they'll pay 85%.
They'll pay what? 25%, right?
They'll pay 5% for the first 5 years. If
After
7
the, after
then
the,
after se-
after the, after the 7 years, what's the tax rate? Waste processing, what's the tax rate after the concessionary period? What's the tax percent? What the tax rate?
I think from 7 years of operation it's 5%, but after that, I'm sure maybe it will go to the normal.
so it will be the normal
To the
20.
normal.
25.
Yeah, 25%.
No, it will not be the 25%. It will be 20%. For 7 years, it's 5%.
Oh, okay, okay.
Yeah. It's processing. It's
Yeah.
processing. So after the 7 years,
Yeah,
if
processing.
it's processing,
Yeah.
after the 7 years, if they are in Tema 20%. So this one, you give them the 20%. Because we are not to
Okay.
where they are located. So the tax rate is the 20%.
Yeah, but senior, please, they said that these businesses commenced operations on 1st January 2022, and we are meant to do the tax payable of assessment 2022. So are we still to use the 20% or to use the 5%?
Okay. They say what the businesses commenced operation. Okay.
Yes.
The commenced operation on what? January 1, 2022. These results are as at what? So it means that they're in the concessionary period.
Yes.
Yes, senior.
Yes. But this question will not be, the idea is not for the concessionary period. It's the locational rate with the different type of industries. So this statement here, if like I see this statement earlier, I'll have removed it. I'll have take it off. So that we know that they're in operation for so many years. So that you know the rate, like what we are doing. But if they commence operations on January 1, 2022, the assessment is also 22, then everything will be 5%. Is that what it?
Yes.
Everything will be 5%. So there will not be any. But the idea for this question is the locational rate with different type of industry. That's the idea. So like I see this, statement, and I will have taken it off so that we know that they're in operations for several years, so that we apply this rate on it. But if the question is like this, in exam, if the question is like this, and they're telling you that they commence business on January 1, 2022, then it means this is the concessionary period. So everything will just be 5%. So what is the examiner trying to do? So this statement will definitely not be there. So that's what I said. The main idea is the locational incentives and the type of industry So let's do the last one. K.
So,
P.
hello,
Yes,
sir.
yes, yeah.
So, from was it started from 2023? The 5% this thing that you're talking about.
Yeah, it's starting from May 2023.
May 2023.
Yeah, previously it was 1%.
Okay.
Previously
May.
it was 1%, but from May 2023 it's now 5%.
Okay.
For the
Thank you.
concessionary period. Now, PKL is a private university. They reinvest 100% of their profits. So what the tax rate? They make a profit of what? 1 million for the year. So what the tax rate?
Exempt.
Exempt.
So they will not be paying any tax. All right. Let me leave this question. I want to talk about merger and acquisition. I want a question on merger and acquisition, so that we will end the tax planning. We go to international taxation. I want a question on merger and amalgamation. Got the location. This one we have done a lot. We have done a lot on it. This one, they say, as a strategic tax planning expert, briefly explain why locating a poultry farm in Wa is more beneficial than locating it in Winnipeg. This one you can explain. In Wa, the poultry farm, they pay 5%. But in Winnipeg, they'll be paying tax at a rate of 10%. Outline any 4 tax benefits available to the Wadawa group of companies under the tax laws. What are the tax benefits that the group will enjoy? State any 2 non-tax factors that may influence the Wadawa's decision in locating a business. The last part D, what are the factors that will influence the group's decision? The non-tax benefits that will influence the decision of the group in locating a business. Just 2.
Access to raw materials.
Access to raw material, access to market, access to labor and the rest. Good. The B part here too is on ethics. It's on ethics. We've done one question on ethics. That is enough. Question 4 is on team capitalization. Good. And team capitalization, we will not bother ourselves on it. Is there any issue on team capitalization? So let's do a quick recap on the team capitalization. Now, we know that debt to equity ratio should be 3:1. The equity will be multiplied by 3 and the debt will be 1. Now, what you need to know, or what you have to identify, is the equity component of the capital structure of the company. Now, the items given to us, we have share deals, 50,000, revaluation reserve, 100,000, stated capital, 150, capital surplus, 100,000, interest on McDonald's UK loan paid in 2022, 200,000, retained earnings, 300,000, foreign exchange loss, 500,000, exchange rate, $1 is 15 cedis, 80 pesos. So requirements. But what is the amount of the loan given? The loan given is 1.5 million US dollars. This is the value of the loan, 1.5. The interest they paid is 200,000 Ghana cedis. The foreign exchange loss is 500,000 Ghana cedis. So the requirements, the first one is to state provision under team capitalization as a mechanism to combat what? The tax avoidance. So we know the provision. Then you have to determine the tax implication of the above transaction. Now, what you need to know, we know the provision already. The provision is that a resident company owned by a non-resident person with 8 associates, or it could be a joint venture arrangement, whereby the non-resident controls at least 50% of the ownership of the resident company. Every transaction between the resident company and the resident person who is the owner must be based on the arm's length principle. And any foreign exchange loss or any interest to be paid on the loan given by the non-resident owner to the subsidiary will be subject to debt to equity ratio of 3:1. That's the provision. The tax implication is you have to identify the extent to which the interest on the loan can be what? Can be deducted. The interest paid is 200,000. The extent is the 3:1 ratio. And I'm saying that the equity will be multiplied by 3. The debt is always 1. So it means that the interest you paid on the loan, you can only deduct the loan value 3 times the amount of the equity. So let's move on. How will you determine the equity here? So the equity component, share this. Is share this an equity item?
No.
So our total equity, I'm solving the question like that too. Our total equity, are we going to add share this?
No,
No,
please.
senior.
Revaluation reserve, are you going to add it?
So,
No,
No.
senior.
Stated capital, are you going to add stated capital?
Yes.
Yes, senior.
So 150. Capital surplus, are you going to add capital surplus?
No.
Are you going to add capital surplus?
No, sir.
Everybody agree that we know our capital surplus.
No, sir. I think it's retained earnings and stated capital.
The retained
Think of
earnings and the stated capital, is that not it?
Yeah.
Right. Okay. So capital surplus will not be added. So the equity items, they are just two. Stated capital and retained earnings. Those are just the two. So know them. If you don't know, you're going to add all of them over the bar. The retained earnings is 300,000. So our equity is 450,000. Multiply this by 3. How much will you get? Or I should solve the question normal. I'm even doing it already. So,
Sir,
Yes.
let's solve it normal.
oh, it's very simple. Okay, so let me do that. So we should solve it normal. It's like I'm solving it.
Yes.
I'm not solving it in any standard way. I'm just doing it anyway, anyhow.
Uh-huh.
Okay. So, what is even the name of that company, Clara?
McDonald.
McDonald Limited, Ghana. It's a subsidiary of McDonald Incorporated company resident in United States. Okay. All right. So McDonald Limited, Ghana. I've talked about the provisions already. So the provision, I'm just stating the summary, is debt to equity ratio of 3:1. All right, so let's find the equity component. So the equity component, we have our stated capital of 150,000. We have our retained earnings of 300,000. Our total equity is 450,000. So this is total equity. Now, let's go to the loan amount, the loan value. The loan is in USD. How much? 1,500,000. So let's convert it to Ghana cedis. The exchange rate is what? 1 USD is equal to what? 15 cedis, 80 pesos. So loan amount in Ghanaian cedis in in Ghana cities, it will be equal to what? Are we dividing or we are multiplying?
We are
Multiply.
multiple.
Fine.
We are multiplying. So
23.7 million.
23.7 million multiplied by 15.8. 23 point what?
7 million.
23,700,000. So this is the loan amount. All right. So now our total equity will be equal to what? 450,000 multiplied by 3. This is giving us what?
1 million.
1,350,000.
350,000.
1,350,000. So this is the total value of the equity. Now, the interest paid. The interest paid is how much?
200,000.
100,000.
200,000. Okay, so the allowable portion of the interest. The allowable interest will be equal to what? 1,350,000 divided by 23,700,000 multiplied by 200,000. How much will be that? How much will you get?
$11,392.4.
11,392.
11,392.
All right. So it means that out of the total interest of 200,000, it is only 11,392 Ghana cedis that can be deducted from McDonald Limited, Ghana Limited before income, before tax will be paid. Now the excess amount, the amount in excess due to the limitation will be the 200,000 minus 11,392. How much will be that?
188,608.
608. What do you do to this amount?
It's allowed.
We
Senior,
disallow.
you disallow add numbers.
Okay, this amount will be disallowed and you add it back. Add back to income and tax. All right, so let's do the foreign exchange loss. The foreign exchange loss is 500,000 Ghana cedis. The allowable portion will be equal to 1.350 divided by 23,700 multiplied by the 500,000. So how much will be allowed?
$28,481.
28,481. So the excess amount will be disallowed and added back to the income of McDonald Limited and tax. So how much will be the excess? So amount disallowed will be the 500,000 minus 48 what?
28,481.
28,481. So the excess amount will be how much?
471,519.
471,519. This amount will be added back to the income of McDonald Limited and tax.
519.
519, not 91. Okay. Thank you, Syria. Any question? I want to do one question on merger and acquisition. Then we move on to taxation of natural resources. I think I should have one question here.
Is that all?
Question 6.
Yeah, that's all.
So please, can you go back to the calculation? I want to look at something there.
While you
I want
compute,
to.
you have to explain. This is advanced taxation. While you compute, you have to explain. And I was talking before doing the calculation, so I was saying the explanation too. This is all. This is all. So you tell the examiner that out of the total interest of 200,000, it is only 11,392 that will be deducted from the income of McDonald Limited before they pay tax. You tell the examiner that the excess amount of 188,608 Ghana cedis will be disallowed and to be added back to the income of McDonald Limited and tax. The foreign exchange too, you say the same thing. While you compute, you have to explain. While you compute, you have to explain. So that Amici, I believe you're okay. So that I can go back to the
Yes,
question.
please. Yeah, I'm okay. Yes.
So
All right.
the 1350 is the only amount, the loan amount that they can take.
The what? The one what?
1350. The total equity.
Yes, yeah. It means the loan, the amount of the loan they can take is what? That when they take it, the interest that they will pay will be allowed deduction. Will be an allowable deduction is the 1.350.
Okay.
Any loan in excess of this amount, when they take, if they pay interest on that amount, that interest will not be allowed. That interest will be disallowed. So if they take a loan up to a value of 1.350 million, any interest they pay on it will be what? Will be an allowable deduction. So I want question on merger and acquisition. Somebody say question 6. Question 5 there. Question 5, I believe you can do question 5. Let me go to. Good. Let's do question 6. All right. The president of America is Great Group, a USA incorporation, is exploring the possibility of acquiring a 50%, okay, 55% stake in Fluid Logistics Ghana Limited. The capital of Fluid Logistics Ghana Limited is 1.5 million Ghana cedis. AIG Corporation intends providing a loan of 6.5 million Ghana cedis to Fluid Logistics Ghana Limited when the transaction for the acquisition of the 55% stake is complete. The president is seeking your advice on the tax implication of the proposed investment. Advise the president on 1, the income tax implication of the acquisition of the 55 stake in Fluid Logistics Limited. So what the income tax implication?
It's exempt.
What is exempt, senior? What is exempt, senior?
So, Senior,
Yes.
so you state all those laws, but the gains on realization on the assets,
Yes.
with the company that is continuing with above 50% ownership will be exempt from tax.
Okay. So
Yes.
the gain, you say first you say you state what?
It's a long sentence in the act.
Gains on realization. That is if it is merger and acquisition.
Derived from or accrued from merger, acquisition, amalgamation.
The law is thinking.
The law is saying that when they have more than 50% ownership,
Okay.
they are exempt.
Thank God. Let's move on. You guys, you know the thing. You know the thing. So let's move on.
Relax.
Oh, but that is it. There's nothing there for me to add again. You guys, you are good. You know the thing. So let's move on. It means when AIG, they want to acquire 55%. So when the acquisition is successful, it will be deemed as if the assets and liabilities of Flow Logistics Limited have been realized. And when they acquire 55%, but first you state your principles, blah, 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 blah. When there's a continuation of more than 55% in underlying ownership of the entity, any gain or realization will be exempt from tax. But when the continuation is less than 50%, any gain will be subject to tax. So you tell them, you are advising them. So the advice is that if they acquire 55%, any gain that they will make on that realization will be exempted from tax. But any gain that Fluid Logistics Limited will make will be subject to tax. Will be subject to tax. Now, there's one thing you have to add again. This is 5 marks. There's one thing you have to add again. You are advising. Is it not what?
The period, like the 3 years.
Exactly, senior. So you tell them, the AIG, their president, that if the acquisition occurs within a period of 3 years, if the 55% acquisition occurs within a period of 3 years, any excess financial cost, any bad debt, any unrelieved loss that Fluid Limited is having, they cannot deduct it. They cannot deduct it. So before they will plan their acquisition, they should check Fluid Limited, do they have any unrelieved loss? Do they have any excess financial cost that they are carrying forward? Do they have any bad debt that they are carrying forward? If they have all those things for tax purpose, if the acquisition occurs within a period of 3 years, then it means that Fluid Logistics Limited cannot deduct those items. So they should check those things before they acquire. But if they acquire 55%, to them, any gain that they make will not be subject to tax. Let's go to the second part. I hope my ladies are following.
Sir, please, so that's it's not all that clear to me. You said that within 3 years.
Yeah, within 3 years period. Within 3 years. Within a period of 3 years. If the change.
When they acquire within 3 years and they don't claim, or
no, this is the way the thing works. You see, for tax planning purpose, a company may be in financial difficulty. A company may be in financial difficulty. They may have unrelieved loss that they are carrying forward. Maybe due to their liquidity problem, then another company wants to come and acquire them. The principle is saying that the company, the acquirer, the change of 50%, we are saying that if the change is 50% or more, any gain will be exempt from tax. So the tax authority, to their sense, 50%, the gain you make, you will not pay tax. Now, if this change occurs within 3 years, year 1 to year 3, you acquire the 50%. If the company you are acquiring, if they have any unrelieved loss, any excess financial cost, they cannot deduct it again. They cannot carry them forward again. It means that the company structure have to change. They cannot carry those things again. They cannot carry them forward again. So the tax planning measure is that you advise them for that purpose. That's what I said. They should check first and see if Fluid Logistics Limited, if they are having any unrelieved loss, any excess financial cost. If they're having them, then they should plan the change. The change should be more than 3 years. It can be 3 years, 1 month. It can be 4 years. In that case, the Fluid Limited can still carry forward their unrelieved loss, their excess financial costs, and the rest. Then I believe you are okay.
yes, sir.
That's the reason why we have the step acquisition. Corporate reporting, we have the step acquisition. So they can plan it. Year 1, maybe they will acquire 10%. Year 2, another 10%. Then year 3, maybe 20%. That's 40. Then year 4, they acquire another 10% or another 15%. That will make it their 55%. If it happens like this, any excess financial cost and any unrelieved loss, the company they are acquiring can deduct it. The second one, the income tax implication of providing the loan to the company. What's the income tax implication?
So in this case, I think we would have to subject it to the tin capitalization first to see if it's within the threshold.
Thank you, senior.
So if it is above, then we need to advise you with regards to the capitalization 3:1.
Okay.
So that
Thank you very much. It's
they
for
will not
5.
be able to provide 6.5 million, but rather lesser amount.
All right. Thank you very much. They want to advise. They don't know. Is it the man don't know? So you want to advise. So that is that perfect advice. You tell the examiner that if they acquire the 55%, they will have the majority share. They will now have the control. Then Fluid Limited will now be what? Their subsidiary. Will now be their subsidiary. Any loan that they provide to Fluid Limited will be what? Will be subject to the thing capitalization rule, the debt to equity ratio of 3:1. You see, the examiner is very clever. They gave you the capital, the stated capital of Fluid Limited to be 1.5 million. They gave you this value. They gave you this value. So you have to do the computation fast. You have to do the computation fast and tell them and tell the examiner. So this one you have to calculate too. So you tell them that they want to provide 6.5 million. The only thing is they didn't give you the interest rate on the loan. Are we giving the interest rate on the loan? No, we are not
No.
giving. So you cannot compute the interest. Then you tell them that the equity, which is the stated capital, will multiply by 3. 1.5 multiplied by 3. That will give you what?
4.5.
4.5. So you tell them that if they give them the loan of 6.5 million, the interest that they will receive on 4.5 will be exempt from, will be what? Will be allowable deduction. The interest they receive on 2 million, that interest, Fluid Limited cannot deduct it from the income before they pay tax. It's not 2 million, it's 2 million. 2 million plus 4.5, that will give you 6.5. Good. The examiner cannot give you any mark less than the 5 marks. So the tax planning options available to minimize the tax effects of the proposed transaction. What the tax planning, I even spoke about it already. What are the tax planning measures?
You said
one
one
is
already
the
that
step acquisition.
Okay. Yeah, I say I even spoke about it already. Okay.
The thing capitalized.
And the thing capitalization. So you tell them that the loan they can provide when they provide 4.5, any interest they pay on the loan, that interest will be what? Will be deductible, which will minimize their tax liability. They can equally do the step acquisition. We are done with tax planning. That's the last thing I want to speak about.
I'm lost. I wish I'll get a solution. Sir.
Uh-huh.
Sir.
I'm with you,
I'm
sister.
lost though. So I wish I get the solutions. Thank you.
You get the solution.
Watch the recording.
We are done. We are done with the solution.
Go and watch the recording.
But I'm saying that you said you will give us some of the solutions, so I'm waiting.
I'll send it. I don't know. But this one, we've answered it already. So
I'm lost. Okay, I'll wait there.
Yes, watch the recording again. You'll be very fine. Okay. Let's go to natural resource taxation. But let's go on 10 minutes break before we continue. The body is tired.
Oh, thank you, sir.
The body is tired.
Let's go on 10 minutes, 10 minutes break.
Sir, you are in the spirit. You are in the spirit.
Yes. So 10 minutes break. It's now 4:30. 4:40, we are coming back. Okay, I think our time is up. So let's continue with natural resource taxation. Are we back? Are we together? Our time is up. Can we continue? Tell guys, let's continue. Let's continue. It's almost 5, so let's move on. So let's move on with natural resource taxation for your 15 marks. Can we continue? Are we here? Hey, Charlie, my people are not back.
Oh, some of us are, but I think let's wait for some few minutes.
Let's wait for some few minutes.
Yeah.
Oh, okay, all right. So like maybe at 4:22, then maybe 4:45, then we start. Okay. Charlie. All right. So let's move on. Let's move on. Now, for mining and minerals operations, we know how their capital allowance work. Their capital allowance is on straight line basis and the rate is 20%. We don't do the pooling system for minerals and mining operations and petroleum operations. We don't do the pooling system. Every cost, every depreciable asset be put in what? In a single pool. All right. Their tax is 35%. But for petroleum operation, there are sources, different sources of revenue to the government. So the government may have the initial interest, which the rate will be agreed on in the petroleum agreement. The petroleum contract will normally be signed between the contractor and Ghana National Petroleum Corporation. The GNPC is always representing the government, the state. So they will sign the petroleum contract between the contractor on behalf of the government. So you have the initial interest, you have the additional participating interest, we have the royalty is there. Royalty in Ghana, we use 5% on gross production, 5% on gross production, which is always deductible for tax purpose. Royalties paid is deductible for tax purpose. Then whatever revenue again, government share of the revenue. We have what other source of share of the revenue to the state? The initial additional royalty. But we have additional oil entitlement, additional oil entitlement. So if during the period, the production, the oil company in the upstream sector, they budget to produce 200,000 barrels, 200,000 barrels of petrol. But at the end, they have produced 210,000 barrels of petrol. The excess 10,000, government will be entitled to a share of the excess 10,000, which what we call the additional oil entitlement. Surface renter is there, and you have to know how the surface renter is calculated from the development stage, exploration stage up to production, how the surface renter is computed. Training allowance and the rest, they're all there. Now, let's move on with the question I have in the intervention document, the question that we are supposed to use to revise. Sister Nyamiche, can you read the question for us?
Okay. Question 1. Naturally, okay. A partnership between GNPC, Kwadaso Exploration Limited, and the Buakwa Petroleum Limited resulted in the commercial discovery and production in the Nkanwie offshore fields. The project involved 3 years of exploration, followed by a 2-year extension and 3 years of development, leading to the start of commercial production in 2023. The fiscal terms of the petroleum agreement between the government of Ghana, represented by GNPC, and the partners are as follows: a royalty of 5%, an initial into bracket carried interest of 10%, an additional participating interest of 5%, a corporate tax rate of 35%, and capital allowance on a straight line basis at a rate of 20%. The consortium of operators commence development immediately upon discovery, with the participating interest as follows: Kwadaso Exploration Limited 35% and Abuakwa Petroleum Limited 50%. Production in the Nkanwie onshore onshore field began in January 2023 with 150 million barrels of petroleum produced that year. Additional information on the petroleum exploration, development, and production operations in the Nkanwie onshore field is as follows. Period to 31st December 2022. 1. Prospecting and exploration cost, $150,000 US. Evaluation and so what is that? Analysis is $1,200,000 US.
It's an activity.
Development cost.
Development cost 2. Hey, this amount is big.
Development cost $2.3 billion US.
All right.
During 2023, average production cost per barrel $50. Average price of petroleum per barrel 120 required. Based on the information provided, prepare a statement of distribution showing the revenue accruing to the government of Ghana from the petroleum produce. Ignore petroleum income tax, if any.
Okay.
B. Discuss 3 key factors responsible for foreign dominance in the natural resources extraction sector in Ghana. C. Enumerate 3 primary sources of revenue from petroleum operations to the state.
All right. Thank you very much.
All right.
So this is a very simple question for 15 marks. Natural resource taxation is 15 marks. So this is a very simple question that you can even close your eyes and get 15 over 15. Very simple question. So this is a partnership. Petroleum sector, it is capital intensive. So normally it would be into a joint venture agreement, or it would be a partnership agreement. Now, based on the agreement, Kwadaso Exploration will have 35%. Ebuakwa Petroleum Limited will have 50%. This gives them 85%. The rest 15% will be held by the government. So government will have additional, government will have initial interest of 10% and additional participating interest of what? Of 5%. That makes up the 100%. Now, for the initial interest under exploration, government does not contribute any cost to the exploration cost. You see, the government only contributes when production starts. So the government only contributes to the development cost. It's additional participating interest. So the development cost, 2.3 billion US. Government will only contribute 5% of that cost. So for the initial interest, that means that the government does not contribute to what? To exploration, prospecting cost. No, government only contribute to development cost. It's additional participating interest. Likewise, government will equally get a revenue equivalent to the percentage, which will be the 5%. So we are to prepare statement of what? Statement of distribution showing the revenue accruing to the government of Ghana from the petroleum operations. This one is very simple. Let's calculate capital allowance first. Let's calculate capital allowance for this question first. Let's calculate capital allowance. Now, before production will commence, we are told that production commenced in January 2023. And the assessment we are doing it to be for 2023 year of assessment. But before, up to 31 December 2022, they've incurred some cost. They've incurred 1.750 million USD on what? On prospecting and exploration. They've equally incurred 1.2 million on evaluation and seismic analysis. Then they incurred 2.3 billion on development costs. Now, all these costs will be capitalized during 2023 years. All these costs will be capitalized, and capital allowance will be granted on these costs. So let's see how we calculate the capital allowance before we come and prepare the statement of distribution of revenue. There's no way this question will come in exam, even though if they ask you this question, there's no way this question will come. Then they'll ask you not to calculate capital allowance. No, you definitely have to compute capital allowance. So let's do that one first. How are we going to calculate the capital allowance? First of all, let's know how the approach before we start the working. How are we going to compute the capital allowance?
So,
Yeah,
hello?
yes, we can hear you, Senator.
Okay. All right. So, we would have to know the total exploration cost and also the development cost. So once we know the total exploration cost and the total development cost, then we would apportion them between Kwadaso, Aqua, and then the state. Already, we know that if it carried interest, the exploration, the state will have a portion of the exploration cost. And also, if it's additional carried interest, the state will also have a portion of the development cost. So in determining their proportionate share, we would have to add those other percentages when we are doing exploration and also development.
But let me get your statement well. You are saying the government will have a share of what? Exploration cost.
So say when we are looking at the carried interest, so if it's for Kwadaso and we want to see the percentage, so 35% is for Kwadaso and then 50% is for Bakwa. But we know that for exploration costs, the carried interest of 5% would have to be part of that proportionate share. So if we want to look at for Pada, so it would be the 35% over 90 multiplied by the total exploration cost. That's what I was trying to say.
No, the initial government does not contribute to exploration, prospecting, and evaluation. No. Government only contribute to development costs. That's all. So the exploration cost here, 1.750. Government will not contribute anything. You see, the initial one, that one is free. The initial one, government will not contribute anything before government will get the revenue. It is only the additional participating interest that governments have to contribute to development costs. That's all. So for the initial interest, there's no contribution made by the government. The government does not make any contribution towards the initial interest. No. It is only when the government, the additional participating interest, that government have to contribute only the cost of development, not exploration, not evaluation, not prospecting. No. So these two courses, the prospecting and exploration, evaluation, and the government will not contribute anything to this course. Government will only contribute 5% of the development cost. Then the other partners will contribute the rest. That's all. So in computing the capital allowance claimable, the first two costs, you don't give anything to the government because the government does not contribute anything. It is only the development cost that government will contribute 5%, 5%, because the arrangement, the additional participating interest is 5%. The additional is 5%. So government will only contribute 5% of the development cost. That's all. So this cost, the first two costs, we are portioning it just between the Kwadaso and Ebuakwa. That's all. Then the third one, you include the state, the 5% share that the state will contribute. So this is natural taxation of natural resources. Question 1. Computation of capital allowance. Good. So we have, what are the name of the companies? The name of the partners.
Buakwa and
We have Ebuakwa, we have Kwadaso Exploration
Kwadaso
Limited
and
and Ebuakwa Petroleum Limited.
Buakwa Petroleum Limited.
Okay. We have Ebuakwa. So we have the states. Good.
Hello, sir.
Yes, Asinia.
Please, at the beginning of the question, there's something over there. If you can go back and so that I check and you check.
Something over.
At the beginning of the question.
Yes.
It said the project involved 3 years of exploration.
Oh yes,
followed by
this one
a 2 year.
they're just telling you about the project. You know, definitely you do exploration first. Then you come and do development before you come and do what? Production in commercial quantity. So that's what they are telling you. This information.
Yeah, but with that, there are costs attaching to it.
Yeah, these are the costs they've given here. These are the costs. So period
there are some rates attaching to. So I was thinking maybe you add it to this cost. That's the prospecting and exploration, because I know that initial exploration period, 2 years, is $30 per square meter.
No, that is surface rental. That is income to government. That is that is surface rental.
Surface rent. Okay.
This is income to government. This is income that government, what government will get. But all these costs are factored here. You see, all these costs are factored in the figure they gave to us over here. It's a period to 31 December 2022. They've incurred prospecting and exploration. You see. So from the prospecting, all the costs they have incurred, that is what they gave us. This is the total cost they have incurred. Evaluation analysis that they have done $1.2 million. So they've put all those costs together and give it to you.
Okay, I get it. I get it.
Okay.
Thank you.
All right. So let's move on. So now for the first course, which is prospecting and exploration, it is only Kwadaso and the Buakwa who will share that cost. So 35 is to 85. No, it's to 50. It's not, is it 50? Is it 35 and 50? I believe so. 35 and 50.
Yes.
So let's share the cost. So for Kwadaso, it will be 35 over 85 multiplied by USD. Why am I using Ghana cedis? The figures are not in Ghana cedis, so you have to do the. So USD is 1,750 million. Is that not it? Then for Ebuakwa, it will be 50 over 85 multiplied by, is it 1.2?
Yes, 1,200,000.
So share it fast. So the first one, what will you get? 35 over 85 multiplied by 1750,000. Approximate the figures to the nearest whole number.
So 720,558.23.
588 or 58?
88.
588.
All right, so let's do it the nearest whole number.
Okay.
So for Ebuakwa, it will be 50 over 85 multiplied by, why am I using 1, 2? It should be the same figure.
1, 2, yeah.
No,
I was about to ask.
But you didn't ask. It should be the same cost, 1750.
Mm.
1029.
So this will be
411.
1029
1029 411.
412.
Okay.
Now let's go to the next course, which is evaluation and now for others, so it will be 35 over 85 multiplied by 1.2. Then for Ebuakwa, it will be 50 over 85 multiplied by 1.2 million US dollars. So the first one, Ebuakwa, Kwadaso, how much will you get?
49411.
So this is
49417.
4118.
117. Okay.
So what about Ebuakwa 50 over 85 multiplying 1.2? 705.
882.
705 882. Good.
2, yeah.
Let's go to development cost. So development cost, which so this one is 35, 50. All right. So development cost, it will be 35 to 50 and 5. Is that not it?
It will be 90.
Which will give us 90. All right. So for Kwadaso, it will be 35 over 90 multiplied by 2.3 billion.
Hi.
What do you get? So you go press the calculator tire.
1, 2, 3.
I'm getting
Hey, I had 894
894
444 444.
All right.
The fours
Somebody
are
can
8.
confirm.
All right.
Yes.
Then let's move on to, so this is Kwadaso Limited. This is the Boakwa. Then you have the state. Then you have total. Good. Then let's move on to Boakwa, which will be 50 over 90 multiplied by 2.3 billion US dollars. Then the state will now have 5/90 by 2.3 billion.
A worker will be 1, 2,
1, 2,
7, 7.
and 7, 7. The sevens are 7.
The sevens are 7.
Yes.
Yes.
They add 8 to it.
As you add 8.
Yeah, after the 7 sevens, then you add 8 to it.
So the last one would be 8.
Okay, all right. Then the state.
One, 2, 7.
1, 2, 7.
Hey, am I correct?
You are.
Yes, you are.
If you are
Yeah,
not,
you are correct.
The same 7, 7, 7, 7, and then the last one be
it's
How
The
many?
last one
0.8.
is 0.8.
0.8. Yes.
How many sevens?
The same 7.
7
1,
sevens
2,
and
3,
0.8.
5, 6, 7. 7. Um,
All right. So now let's find the total, the depreciation base, so that we can calculate our capital allowance.
The state is 12777.
I've written down already. So our depreciation base. So a worker will be what?
A minute, sir.
Should I go back so that you see the previous figure?
yes.
Yes, sir.
So that'll be 1029412 plus 705882 plus your 1277 777 778. So this will give you 1279
795
513 072.
Yeah.
All right,
That
so
would be,
let's go to
That of Adam. So I have 895
wait, let me write 895
95 659
659
150.4.
15150.
0.4.
Okay, leave the points. Okay, so the capital allowance, the rate is 20%. So multiply all of them by 20%. So this one, I think I have
I'm getting
255,902 614.
the first one.
Yeah, the first one.
179
179
131
131
830.
830. Okay, so the last one.
last one. 25 555 5556.
So these are the capital allowance. So you add all of them, then you know the total capital allowance. Now, let's do distribution of crude oil. Distribution of crude oil.
Yeah, no.
I think that is basically the requirement. So prepare statements of distribution showing the revenue accruing to the government. All right. So let's do that. So production for the year is 150 million barrels of petrol. That's what they have produced. So first of all, before you distribute, royalty must be paid. Royalty is on gross production. So let's do that. So production for the year is 150 barrels. So production is 150 million barrels for the year. That's what they have produced. Then royalty will be computed. We know that royalty is on gross production, 5% multiplied by 150 million barrels. How much will you get? 5% of 150.
7.5.
7.5 million.
7.5 million. This will be taken out. Take it out of the 150 million. The net production will be how much?
142 500,000.
142 500,000. Good. So this, yes.
That is a question.
Okay.
When do we use the royalty to be 10%, or it's always 5%? I want to know if the royalty sometimes change to 10%, or it's always 5%.
No, in Ghana is 5%.
Okay, but any other country?
But what?
Okay, I understand. Thank you.
Yeah, royalty in Ghana we use 5%. We use 5%. So if the question did not tell you, know that royalty will be computed 5%. You cannot leave it. 5% will be computed. So we know our net production. Now let's share it. Let's share the net production. So first, initial interest will be taken out. How much is the initial interest? Initial interest
10%.
10%. So that will be 10% of what?
142
500,000. So this will give us what?
14,250,000.
14,250,000. Good. Additional interest will go.
Yeah.
Additional
5%.
interest will follow, which is 5%. So 5% of 142 500,000. How much will you get?
7,125,000.
7,125,000. Good. Then we go to the partners. Kwadaso Limited. We take 35% of 142 500,000. How much will you get?
49,875,000.
49,875,000.
5,000.
5,000. Good. Then Ebuakwa will take 50% of 142 500,000.
71,250,000.
71,250,000. Good. Is there any other thing again?
No, that's all.
We have finished distributing. Now let's compute the revenue to the state.
Yeah.
So total revenue to the state, which will be in US dollars. So we have our royalty, which is, how are you going to compute the royalty?
You have the volume already, and they've given us the price.
Okay, the volume is how much? The volume is 7.5. So multiply by
120.
The selling price is 120. Is the selling price the 120, or that's the cost of production?
No, that's the selling price. The average price of petroleum per barrel.
Okay, so 7.5 multiplied by 120.
That will give you 900 million.
900 million.
Yeah.
Good. Then the initial interest will come.
Yeah.
The volume is 14,250,000 multiplied by 120. Additional, that will give you
1.7 billion. So 171,000,000.
1.7.
Yeah, so 10 million.
Okay, all right.
One seven one, then 7 zeros.
1,710,000,000.
So 171, 7 zeros. 171, 7 zeros.
Okay.
Yeah.
Then the additional interest, which is 7,125,000 multiplied by 120.
855 million.
855 million. Any other revenue to the state again?
Yes. So we need to compute the income tax.
Yeah, they say you should ignore that.
Okay.
The question says
Okay.
you should ignore that. But let's do it. We are learning, so we have to do all of them. They say ignore petroleum income tax, if any. You see that?
Any.
Yeah.
Okay.
So you should ignore it. But we are learning, we are doing revision, so let's do that. Or let's also ignore. Let's follow the question.
But what if you ignore your incomes in the exam? So let's do it.
But I know if we can, before we can do, unless we do all those ones before we come to the revenue to the
Yeah.
state.
It's true.
Unless
Yeah,
we
it's
go and
true.
calculate everything.
Unless
Yeah.
we go and do the respective
Companies, yes.
companies. Then
Yeah.
before we calculate. Okay, all
Before,
right, that's fine. Okay.
but we can do it.
Okay.
We can do income tax payable by the company. So let's do it. But the question says we should ignore.
Yeah.
The question says we should ignore. But if like you should ignore, then this should be the only revenue to the state. You just add these three, that's all. Then you are done. But we are revising. So let's do that. But that one we know how to do it already.
Yeah.
It's very simple. For Kwadaso is having 49,875,000 barrels. Okay, let's do it. So income tax payable. So Kwadaso. So their production, their share of production is what? 49,875 multiplied by, so this is revenue. So the revenue they'll get
120.
multiplied by the 120, yes. So this is their revenue.
Yeah.
So multiply by the 120, how much will you get? Then their cost, their production cost.
5985 million.
5985 million.
5985 6 zeros, yes.
6 zeros.
Yes.
So that means it's billion. All right. Then their production cost, which will be 49,875,000 multiplied by, how much is cost per production?
50.
50. So you multiply this by 50.
2493
2493
7540.
751234. Good. So you take the production cost out.
They give you 349125
349125 4 zeros. Good.
4 zeros.
Now, what do we less again?
Capital allowance.
Less capital allowance. This is the accessible income. So we less capital allowance. How do we get the capital allowance? We've calculated that already. Is that it?
Yeah,
Yes.
I've
Yes.
done
We
it.
solved it
Yes,
already.
yes.
So for Kwarasu, the capital allowance is 179,131,830. Somebody should write it down fast. I know that one.
131,830.
179,131,830.
Okay.
For Ebuakwa is 255,902,614. So we take the capital allowance out. So for Kwarasu, what's the capital allowance?
So, senior, you see that? Oh, sorry. Okay, yes.
Is it that what, senior?
179,131,830.
So
If we were to do the this one,
if we were to do
you know,
what?
can I talk?
Yes, talk, senior.
It, it's because we are learning and we are calculating all these tax issues.
Yes.
Had it not been that, we would have gone back to do all the capital allowance calculation before coming to do this one.
We have that capital allowance. We have that capital allowance already.
No, I know. I'm saying that.
Yes.
Now that we have decided that we want to calculate the taxpayer,
yes.
If it were in the question, like it was part of the question, we would have gone back to do the capital allowance because the capital allowance was not even part of the question. We did it.
Yeah, we did it. Yes.
The
capital allowance was not part of the question. We did it. Yeah. Oh, the requirement of the question is simple. It's just from year to year. Just starting from distribution of the crude oil. Then you come and do the status. Just up to here. That's all. But we want to use one question and study the whole thing, how everything will be done.
Yeah, I get it. Sure. Thank you.
That's the reason why we did the capital.
They can bring this question up.
Come again, senior.
This question can come up. I'm saying this very question can come.
Oh, yes. This very question can come. Yes. this very question can come. I know where I got the question from. So this very question can come.
Why I'm saying this because I remember when we were solving the VAT.
Yes.
And then you were taking us through and all of that, and we were just of the view that so why if they don't bring this VAT similar question? And lo and behold, the pilot questions that they brought was similar to what we did.
Yes, or similar, yes. I know the questions we are solving, especially the questions in the mock. At least you will see some of those questions in your exam. I know. This one like this can come, yes. I know where I've gotten this question from. I will not tell you. This question can come. But the only thing is you cannot trust ICAE. If you don't see it, you see similar thing. That one there is there. But when it's come, they'll ask you to do all the things. So you calculate capital allowance, they will tell you to input the capital, the petroleum income tax. This question was given to tertiary students. So that's the reason why they told them to ignore. It was for university students. Their end of semester examination. That's the reason why they told them they should ignore the income tax. But for professional level, you will not ignore, you will do it. So what is the chargeable income? The chargeable income is what?
331218170.
So the chargeable income. So it tax at 35%. So the tax is how much?
Just a moment.
1.
1159
1159
241 360.
241 360. So this is the task. So the state will get 1159 241 360. All right. Now let's go to the income tax payable by
Ebuakwa.
Buakwa. You are seeing the question small like that. It will work there. The figures are even big. Me, that is annoying me. So their revenue, their revenue will be 120 multiplied by what? Multiplied by 71
150 million
712
250,000.
So that will be what? Then their cost, their production cost will be 50 multiplied by 71 250,000.
855 7 zeros
855.
7 zeros.
Okay. Then what about the cost?
Senior.
Yes.
Ebuakwa share is 1,200, 1,000,000 something, not the 7,250.
No. That share, that's capital allowance. That's capital allowance. That's not the share. The share of revenue is this one. 50% of this. 71 to 50,000.
Okay. I'm seeing the 7 as 1. Thank you. Sorry.
It's 7. It's 7, not 1.
Thank you.
35
So the cost is what? 35
6 to 500,000.
6 to 500,000.
500,000.
Okay. So take it out of the revenue. So the accessible income.
498
498. See, I come again. Your network was singing, so I couldn't hear you.
875
49875.
5 zeros.
Okay. So take it out of the okay, this is the chargeable income. All right. Then we less capital allowance. So we take out the capital allowance. How much is the capital allowance?
Unless you go back.
Did Richard do that?
Yeah.
Okay.
It's 255 902
902 Is it my net?
614.
See, I come again. My network was breaking, so I couldn't hear you.
614.
614. All right. So
614.
take the capital allowance out, then you get our chargeable income.
All 7
47
31
31
5
mm-hmm.
597 386
47315
97 386.
386. So the tax is at 35%.
16
16
56 05 9085.
Good. So this is the tax. So let's go and add it to the state share, the state revenue. So that figure, so now I hope you have it on the calculator.
16.
All right, let me go back.
16.
16
56
56
05
98
9085 9085.
9085. All right. So you add all of them, that will give you the total revenue to the government. You add all of them, that will give you the total revenue to the government. All right. So we are done. Done with that question. I believe my ladies are fine and they are doing well. This was like we left them behind, but I believe they are fine.
We'll be fine.
This question, solve it again. Solve this question again. Solve this question
They
again.
should just add capital allowance 5 marks so that it will be 20 marks for the question.
Oh yeah, when it comes, it will be more than the 9 marks. It will be like 12 marks. It will be like 12 marks. Then this theory, any of these theory can come in addition, making the 15 marks. So the theories, you have to do justice to the theory.
Oh.
Hey, today we have done 4 hours already, and we are still back. We have not gone anywhere, Charlie. So when are we meeting again? It means we have to meet again. When are we meeting again?
Senior, will tomorrow be fine with you?
Tomorrow I have 2 classes, Charlie. Very choke.
Oh, okay.
Tomorrow
What about Monday?
Oh, no problem. Me, I'm ready. Within from Monday to Friday, I'm not going anywhere. So I'm ready.
Okay,
So
so
Monday we can kill this, right?
Monday we can do what? Oh, Monday
Like we can finish all the questions in taxation.
Oh yes, Monday we can finish. We can finish the rest. It's left with 3
Please,
topics.
Monday, what time? What time?
It's left with 3
It
topics.
should be in the evening.
Oh, Monday there is to be in the evening. It will be from 6 to somewhere 10 or 11. Then we are done. But I don't know that Monday if you don't have any class, any other class that Monday.
I don't have any other class. So the others.
Some of us have corporate reports.
Yes, I know there will be other class. There will be other class on that Monday. But those people they can watch the recording, Anna.
Yeah.
Yes. Yes.
Because there no day.
Oh, we beg you Tuesday.
Because
No,
Tuesday.
like Tuesday we have class.
Which class?
Tuesday,
So
they
you
were
can
not
watch
doing.
the recording.
So Tuesday people can watch them.
No, sir, Monday.
The last class I watched the recording. So I mean some have to sacrifice, Otherwise,
So Tuesday
never...
people.
So sir, Monday.
What about
Tuesday?
afternoon?
Thank you so much.
Monday afternoon.
No, Monday afternoon.
Monday afternoon.
Monday afternoon.
The daytime.
Let's say from
When?
1 to 5.
Yes.
1 to 5 is okay.
Monday.
Yes.
Yeah,
1 to 5
Monday.
is fine.
I'll go to work.
Monday.
I'll go to work.
The daytime,
So we'll be
the
doing
afternoon.
it. We won't go to work.
I'll go to work.
Please, the working hours is not favorable. Let's do it.
Yeah,
in
the working
evening.
hours
In
there
the
will not be
evening, Monday
favorable.
in the evening.
Oh, Monday evening. I mean, we have a lot of people who are
Yeah.
doing copy.
Yes.
So
So
Yeah.
if you
yeah,
if
so
you do that, you
yes,
take that.
yeah. So Tuesday, Monday. I don't want to interrupt with the corporate reporting class
Yeah.
because
Yeah.
corporate
They
reporting.
will watch the recording.
No, corporate reporting too.
Please.
But Tuesday, what class do you have on Tuesday? So let's do it on Tuesday. Corporate reporting. I don't want to interrupt the corporate.
You have class on Tuesday. Oh, Charlie.
We don't have any class on Tuesday. No.
Yeah.
Let's do it Tuesday from 6 p.m. to when we are done. Then that is it. But we are finishing the natural resource taxation. Anyway, now how we will finish. Even that question we have solved is heavy enough. So let's go to the question 2. I think question 2 is the pilot question. So you guys have solved it already. This is a question 2. This is a pilot question. So compute the crude oil distribution, compute allowable deduction, explain basis of your computation. This is the pilot question. Very simple. So this company, Abba holds 35%, Baba holds 45%. All right. They have a joint license operate 2020. Okay, they started 2020, operate in the Volta Basin. They commenced operations in 2023. The following relate to their 2023 year of assessment: exploration costs, development costs, production in barrels, crude oil days. Oh, this question is very simple. Initial carry rate 15, additional 5%, royalty. Royalty, they give you 10%. So use 10%. What they give you, use that. Even though royalty in Ghana, we normally use 5%. But if the question gives you more, this question, they are giving you 10%. So use the 10%. So this question is even simpler than the one we have worked right now. So this one, I believe we don't have any problem with this one.
So the capital allowance deduction, are we going to use 20% on the amount we will get after the calculation?
After you share the cost,
Okay.
you multiply it by 20%.
Okay.
Yeah, the rate is 20%.
Okay.
So after you are done sharing the 3 courses, exploration, development, and blah, 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 you apply 20% on it.
Oh, sir, go back to your screen. Let me screenshot, please.
From here or where?
No, the second part and the third part. Let me screenshot. Okay. So now the other one.
So this is the capital allowance. The rate is 20%.
Yes.
So this is the cost, the depreciation bill. Just multiply by 20%, then you get your capital allowance.
Okay. So let me screenshot. Thank you. Last one. Let me screenshot. Thank you.
Now, please go to the first one for me.
I will share this. So I'll share this on the page.
Okay.
I will share it on the WhatsApp page. It has to go to the first one for you. I believe this one.
Yes.
Okay.
Thank you.
Anyway, anyhow, you finish natural resource taxation before you close today. So that we left with 3. Those ones are just theory. We can use 2 hours and finish them. So this question is a compute the crude oil distribution. It's very simple. The production is 1 billion USD. So just share it. First, take royalties out, like what we have done. Royalty is 10%. Take it out. Then come and share it. Government to take initial interest 15% of the net production. Additional participating interest 5% of the net production. Then the rest share it. The other 2 partners, 35% and 45%. Then you are done. Then the next requirement, allowable deduction. That is capital allowance. Compute the allowable deduction. That is capital allowance they ask you to compute. So the first cost, exploration, you only share this cost between Abba and Baba. So it's 35, 45. The total is 80. It's not that, yes. That will give you 80. So just do it for Abba. That will be 35 over 80 multiplied by 2 billion. Then for Baba, that will be 45 over 80 multiplied by the 2 billion. Then come and share development cost too. The development cost, government will contribute to the development cost. So government will contribute the additional participating interest, which is 5%. So when you are sharing, it will now be 85. So that will be 35, 45, and 5. That will now be 85. So Abba will take 35 over 85 multiplied by the 6 billion. Then Baba will take 45 over 85 multiplied by the 3 billion. The state will take 5 over 85 multiplied by the 6 billion. That's all. Add them together. This one just 2 costs. Add them together, then calculate your capital allowance. You are done. Explain the basis of your computation. This one, you are not calculating any revenue or anything. This one is very simple. Question 3 is on mining. So this question, I've solved it before. The solution is there. Can't really go through it again. It's very, very, very important. This question, I've solved it in class, but I brought it here as a reminder so that you revise it again. But for revision's sake, let's go through it. I think this will be the last question we do. The other questions on petroleum mining operations, that one have covered all of them. Now I've covered all of them. Now let's discuss financial cost and financial gain. Let's talk about that one before we look at this question. Now, under mining and mineral operations and petroleum operations, financial costs will be allowed to the extent of the financial gain. That's all. Our first meeting, we discussed the one in the normal course of business. That financial cost will be financial gain plus 50% of the adjusted chargeable income. Under mining and minerals operation and petroleum operation, financial cost is equal to financial gain. That's all. The excess amount, you add it back. You add it back and still carry it forward for the next 5 years. Simple like that. So this company, this question is a mining company located in the Bono region. Mining companies, they don't enjoy locational incentives. Wherever you are, your tax is 35%, whether you like it or yes. Mining and petroleum company, they don't enjoy that locational incentive, no. So 2022, the net profit is 1,125,510,000 Ghana cedis. Now let's consider the additional information. The following additional information is relevant for the 2022 year of assessment. They conducted research and development, 3.3 million Ghana cedis. Research and development under mining and mineral operations, is it an allowable deduction?
No.
No, we don't allow. We don't allow research and development for a mining and mineral operation companies. The reason is that for exploration and development and prospecting, for exploration and development, you are just doing research. So we will give you period to do research. So when you start production, you cannot come and tell us that you have conducted another research again. Then you will deduct it. That is not allowed. So add this 3.3, add it back to the net profit. Depreciation is not allowed. Add it back. Is it this question? This question here. The additional information is the same as the one we solved under the Yao Limited. Is that not it?
Yes.
The more question, that Yao Limited question. The additional information is not the same as the figures. Are they not the same as that question?
Then let's solve it.
We are solving. We are solving.
We are solving.
Or I should be writing the solution.
Yes, I mean writing on board. Yeah.
Hey, then I go write out. Okay, let's solve it. The classical is what time?
It's 7.
7.
It's 7, but it must be treated by 6.
Today you watch it.
It is possible. It is possible.
If I don't want that much, I will die.
All work cannot play.
Did you say if you don't watch, you will die?
Yes.
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 Hey.
All work cannot play.
Hey.
Madam, we need to.
Hey, sir.
So, 2 miles, question 3. It's 5:52, Charlie. Let's stop here and continue next meeting. Or
yes, I support.
Oh, so let's discuss it. Then the next time we'll
so let's
solve it.
Yes. So we are discussing it.
Discuss.
We can just finish within 2 minutes. All right. So you start with the net profit. Let's see the requirement first. I think you are supposed to compute the tax payable. The tax payable. Yes, the tax payable. All right. So you start with the net profit. So do the net profit. You do the additions. 5,000 plus 50%. 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 5,000 plus 50 Research and development is not an allowable deduction for mining companies. So you add the 3.3. You add the depreciation. We know depreciation already. This one, there's nothing to say about it. Now, the third additional information, the company has been engaging in hedging to secure its revenue from fluctuations in foreign currencies. In the first quarter of 2022, financial cost 21 million was incurred. Financial gain 12 million was made during the last quarter. All these were included in the profit. So I'm saying that for mining and minerals operation, financial cost is allowed to the extent of the financial gain. The excess, you add the excess back. In this question, they have already deducted the 21 million and they have included the 12 million. The 12 million is a gain, which is supposed to be added. That was in place. But the excess, which will be 21 minus 12, that will give you what?
9 million.
9 million. Add this 9 million. Add this 9 million back. We cannot allow you to deduct the 9 million. So add the 9 million back to profit. So this is excess financial cost, which will be disallowed. Add it back to profit. Then, okay, there's another class. All right. Refreshment and entertainment. Add it back. You don't allow refreshment and entertainment. It was included in the production cost, so add it back. Costs incurred in overburden stripping and shaft sinking during production to improve access to this one I've explained the last time already. So this one is an allowable deduction. They have deducted it. That is in place. No, you allow it. I've explained this the last time. So the first recording. The cost was incurred to improve access to the ground for production. So it's an allowable deduction. You deduct it. So they have done that already. That is in place. You leave it. Contributions towards approved rehabilitation fund. This was included in the cost of operation. This is an allowable deduction. Any money contributed to rehabilitation fund is an allowable deduction. And for petroleum, it will be decommissioning fund. Any amount contributed to the decommissioning fund is an allowable deduction. So they have already deducted it, so it's in place. Leave it for them. Royalty of 150,625,000 was paid without recourse to the production. You know that royalties should be computed on gross production. They pay 150 million, but in actual sense, how much should be the total royalties that they have to compute it? That would be 5%.
5% of the revenue.
Multiplied by 3. The revenue is what? 3 million what?
3,712,530,000.
3,125,30,000.
3,712,530,000.
So that'll give you how much?
That'll give you 35 million. Hey, sorry, that will give you 185. Oh, I have already done the
185.
You have
626,500.
185, 626,
500.
500. They have deducted only 150. So the difference is how much?
SS 35.
35,000
million.
This one to
3,500,000. So 35 million. Sorry.
35 million. 35 million should be what? Should be deducted as additional royalty. Is that not it?
Yes.
So 35 million should be deducted as additional royalty. Good. Sister Juliet, I believe you are following. She's fine. She's fine. She's very fine. She's not talking. That means she's fine. 10 fresh graduates were recruited in 2022. You know that the first graduates already. These people know the computer school in Ghana. 4 of the first graduates completed university in the United States. The rest completed UDS in Ghana. So out of the 10, only 6 completed universities in Ghana. So the additional deduction would be pertaining to only the 6 that completed the universities in Ghana. Total workforce is what? Is 60%. So the percentage will be 6/60 multiplied by 100. That will give you 10%. Is that not it?
Yes.
So it means that it is about 5%. So 50% multiplied by the 1,800,000. That will give you, what will you get?
900,000.
900,000 is an additional deduction. So go and deduct it. Go and deduct it. Written down value.
Sir.
Yes.
So this is where we will multiply by the 6 over.
Yes.
Yes.
Multiply by what? Yes. Because
yes,
all
this is
of
where, yeah.
I didn't get the 900,000.
All of them were paid 1.8. Yes, you are right.
Exactly.
So yes, all of them were paid this amount. You see, the one we solved under your limited. The scenario was is quite different from this.
Yeah.
So it's in my head. So I'm rushing. I want to go and watch football. So I'm rushing. Then you multiply by what? 6 over 10. Is that not it? You multiply you multiply the 1.8 over 6 over 10 before you find the 50% of it.
40,000.
Okay, whatever you get, 40,000. All right. That will be additional.
40,000.
All right, thank you very much. That will be the additional deduction. Written down value of the depreciable asset of the company brought forward. 3 years capital allowance was granted, stood at 600 million. So it means that capital allowance is 20% on straight line. So if 3 years have already been taken out, this is equivalent to how many years? To 2 years. Is that not it?
Yes.
So you have to gross it. So in grossing it, there is 600 million divided by what?
40%.
0.4. That will give you the cost. Somebody
Please
say,
come again. I didn't get that one well.
wait, let me check the chat box. People are saying something, so let me. ECG has done it again. Okay, good. They will always do it. They'll off your light. Sister Namiche, you say you have not gotten what? You have not gotten it yet.
Yes, there's 600 over 0.4. Could
Yes,
you
all right.
please come again?
Okay, don't worry. I'll come again. I'm moving keke, so I'm moving slowly. It's keke I'm using, so I'll come right now. You know, capital allowance for mining and mineral operation is 20%. Is that not it? Which is equivalent to which is equivalent to 5 years.
Yes.
5 years. The written down value 600 million.
Yes, please.
We were told that 3 years capital allowance was already granted before they got the written down value to be 600 million. But the capital allowance is on straight line basis. It's on straight line basis, which is always on cost. So you must find the cost before you can grant the capital allowance. So what you can do is, if 3 years has been taken off, it means 60% is gone. So it's left with how many percent? 4%. It's 40%. And 40% is equivalent to 2 years. So to get the gross amount, just divide this one by its equivalent percentage. So just divide the 600 million by 0.4. It will give you the gross. Or you use the other approach. You are looking for 100%. So that will be 100 over what? 100 over what?
Okay.
100 over 60.
Over 60.
Will it be over 60?
Yeah.
Multiply by the 600 million to give you the same value. But me, I like this one. I like the first one. Just divide by and gone. Because this is equivalent to 40%. So let me divide it by its equivalent percentage. That's all. This 100 divided by, I don't have time for that one. So let me just divide sharp. I'm gone. So that will give you the capital allowance. Deduct the capital allowance. Get the chargeable income. Multiply by 35%. Get the tax payable.
Or better still, divide by the number of years left by 2. Then you are fine.
Thank you, senior.
Sir, please, the first graduate, I didn't get, I got 900,000.
Yeah, the 900,000 is the first graduate. It is not all of them that graduated from universities in Ghana.
Oh, okay.
It's only 6. But the 10 first graduates, 10, all the 10 of them were paid 1.8. Is that not it? But the additional deduction will only be equivalent to the first graduates that have graduated in Ghana. So if 10 is equal to 1.8, 6 will be equal to what? So we are looking for the 6. So that will be 6 over 10 multiplied by 1.8. Whatever you get, multiply by 50%.
Okay.
Are you okay, senior?
Yes, sir.
All right.
540.
Okay. So we are done. We are done with natural resource taxation. Solve the rest of the questions for your revision. So the next meeting, we are starting with international taxation, whatever, for 10 marks. International taxation for 10 marks. It left with fiscal policy and tax admin for 20 marks. Then VAT for also 15 marks. Hey, we have so many marks to achieve. That's 45 marks. So we meet on Tuesday and grab the 45 marks. Any question?
The time, please. On Tuesday, what time?
6 p.m. to until we are done. 6 p.m. till we are done. But the rest of the things we will finish. We did by 3. Within 2 to 3 hours, we are done. Yes, because VAT, we know VAT already. VAT, I can use 10 minutes to finish VAT. The rest of the things are theory, so you have to go and read. So I'll tell you just to go and read. That's all. So the calculations, I can use 10 minutes or 15 minutes to finish VAT. Fiscal policy and tax admin is also theory. Just theory. Then it's international taxation that you have to the relief and all those things. You have to do some computation, know how you have to. That one we will solve the question 1 here. You solve the question 1. Then I'm sure there are some good questions. Yes, question 2. Well-loaded question 2. We'll solve it. Then maybe some other 1 or 2. Then we are done. The question 2 is loaded. So question 3 too is there. Then maybe you solve the rest. This one, maybe you come and solve this one yourself. But for your revision sake, start solving them. Start solving them. So I believe we don't have any questions. So we will end the class here and meet on Tuesday.
Thank you, Senior. Thank you.
All right.
Thank you, sir.
Thank you, sir.